Hi everyone, it's Matt. I'm the lead trainer at Safety in the Market, and welcome to our 7th and final video in our FX trading course. In this video, we're going to take a look at setting up for an FX trade. Before we do that, just a quick recap of what we've learned so far. In part 1 of the series, we had a quick introduction to FX trading, and then in part 2, I went through each of the individual components of an FX trade from scratch. So looking at margins, position sizing, tick value. Then in part 3, I jumped straight in and took an FX trade so that you could see from start to finish how that all looks in a trading platform. And then in part 4, we took a deep dive into account management and position sizing. Now, that's a pretty big topic and there was a lot of ground covered there. And at some point, you may need to revisit that video when you're doing your FX position sizing. That's a crucial part to get right in your trading. Now, these first 4 videos provide a solid foundation for anyone who's perhaps been trading for a little while and is now deciding to come across to FX trading. We cover all of the fundamentals, taking a trade, the different position sizing, because it is a little bit different taking an FX position versus taking a stock position, but all of your basics are covered in those first 4 videos. Part 5, we moved on to analysis in the FX markets. And this is where, again, if you're a technical trader, you've got your trading system already, you may not need this one too much if you already know how you want to trade. If you've got a profitable system that's giving you high reward to risk ratio trades, great, stick with that and keep trading that. But for those of you who are fairly new to trading, well, this is an opportunity for you in video 5 to go through the different fundamental and technical indicators that are out there and have a look at the sorts of things that you could consider putting into your own trading system. And then obviously at the end of that, I show you my trading system and how I analyze the markets. So I'll give you a brief recap of that in a couple of slides' time. Then in part 6, some would say this is just a bonus and not really relevant, but I think lessons from history are so crucial, so important. If you think about it, imagine if everyone you knew, all the politicians, elected officials, business owners, etc., if we all learned our lessons from history, how much further along would the human race be? But obviously we can't control that, but what we can control as traders is our own trading journey and our own trading improvement. And there are lots of key nuggets in here that you can learn from history that are going to shortcut your learning curve to being a professional FX trader. So I'd strongly encourage you to watch that one if you haven't already done so. So all 6 of those videos were preparing us for this final video where we're going to take a look at setting up for an actual FX trade. By this stage of the game, we've performed our analysis already, whether that's fundamental analysis, technical analysis, or a combination of the two. We've performed that analysis, and our analysis has led us to an expected direction in the market. So we are expecting the market to go up, we're expecting it to go down, or we're expecting it to go sideways. And if we're expecting it to go sideways, we would probably sit out of the market and wait for it to start trending again. Of course, there is a fourth outcome here. Sometimes we'll perform our analysis and we still won't know which way the market's going to go. And in those cases, I like to remember the words of W.D. Gann, who said, if in doubt, stay out of the market. So in setting up for an FX trade, you need to have a method of trading that you're going to repeat each time that you trade. Professional traders don't just turn the computer on and think, oh, I'll have a look and see what's out there, or open up a few charts, flick through them, and then I'm bored of this, I'll just pick this one. They have a set procedure that they go through each time they take a trade. And for me, it's a simple 3-step process, which we discussed in part 5. The first thing that I do is I follow the trend of the market. So a market might be trending up, in which case it's moving up, and I'll want to take a chunk out of that trend. If I can, I'll try and capture the entire trend, but in most cases, you're looking to capture a chunk of the trend. So you'll be looking, if the market's moving from a low up to a high, you'll want to get in as close as you can to that low and hold that trade as long as you can until the trend ends at the new high. And the way that I follow the trend of the market is using swing charts. I love swing charts, as I discussed in video 5, and I look at swing charts across multiple time frames. Now, once you know what you're doing with swing charts, they're a very, very powerful trading tool, and you can learn more about those in the Active Trader Program online training. Now, following the trend is the first step, but I then add a second layer of analysis in there where I look to find the turning points. Now, when I say turning points, I'm talking about tops and bottoms in the market, and there are tops and bottoms on all sorts of time frames. if you look on a big picture chart that's showing you 20, 30 years of price data, you'll see very massive turning points, all-time highs and all-time lows. But turning points can also be on a daily or a weekly chart. They can also be on something like a 1-minute chart or a 5-minute chart. So I will look at the trend time frame that I'm trading, and I will look at the turning points or the relevant turning points that are nearby, and I'll look to incorporate that into my trend analysis. The net result is I'm looking to trade a particular trend, so I'm trading in a certain direction, and then I want to know the cutoff point. I want to know the turning point that is likely to happen next so that I can take my profits there and perhaps enter a new trade in the opposite direction. Now, those two steps will give me my outlook for the market and the direction that I want to trade. And from there, it's simply a matter of turning to my trading plan and looking for opportunities to trade in the direction of that trend. So that's the process that I use. It's always the same. I go through my swing charts, I go through my price forecasting, and then I use my trading plan to trade them. Now, that whole process is taught in the Active Trader Program online training. I've mentioned that a few times already throughout this program, but if you would like to check that out, you can click on the link in the description to this video, and that link will take you to a free demo version of this program where you can have a look at the first 15 lessons for free. So if you would like to get started, all you have to do is pop your name and email address in there and you can get going right away. No credit card, no payment required, no personal details, just your name and your email address. So before we can set up for an FX trade, we need to have performed our analysis. I'm going to skip that step because we covered it all in part 5 of the series, but I'm just going to revisit a slide from that video, and it's this one here. When I'm looking to take a trade, this is what I am looking for. And note the two things here. Number one is a swing chart. We have a trend in the market, and the market is making these higher tops, higher bottoms, a little bit like stairs, and it's running up here. So that is an uptrend. Then we have these horizontal lines here, and there's about 6 lines that you can see there, all very, very close together at this top here. And what these are price pressure milestones in the market. Now, one of these milestones by itself can turn the market, but if I have a whole cluster of these together, all very tight together, usually within about 0.5% of each other, if I have that tight cluster, I know that there's a very, very high probability of a change in trend at this point. So they're the two things that I'm talking about, trend and turning points. Here's the trend, it's up, 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 and the trend is up until it ends. And at this point here, it hits this price cluster, which is like a brick wall in the market. It hits there, it can't go any further. In fact, it double tops at that level, and then it turns around and it starts a new trend to the downside. Now, before I move on, I just want to highlight the importance of combining these two approaches. If we're just using swing charts, you don't know that the trend has changed until this point here, which is a fair way from the top. So swing charts alone are designed to help you get a chunk out of the middle of the trend. Whereas if you can layer in price forecasting on top of that and find these turning points, you can have that confidence to hold that trade all the way up to the top. And then when you get there, to take profits very close to the top and maximize your profits there. It's by combining these two techniques together that you're going to be able to take trades with a reward to risk ratio of 10-to-1 or more. So when I say I'm setting up for an FX trade, this is my usual starting point. I have a cluster in mind, and I'm looking at what I think is the start of a new trend, and I look to take a trade there. And that's for the majority of my trades. Occasionally there will be a slightly different looking pattern or setup there, but that's how the majority of my trades start. I want to enter as a new trend is beginning, and I want to enter with a very small risk, which is what's going to give me a high reward to risk ratio. Once I'm at this point, once I've got that picture and I've identified that turning point and the beginning of a new trend, it's time to fill in my trading plan. Now, if you're new to trading, you might not be familiar with the concept of a trading plan, but all professional traders use trading plans. Things can happen very, very quickly in financial markets, and even when we're experienced, we may not be able to react quickly enough because so many things happen at once, and you've got to process all of those things and then try and make a decision. This is why pilots have specific flight plans, and if something goes wrong while they're flying the plane, they don't have to scratch their head and think, oh, what should I do about this? They go straight to their book and they have a look at the certain scenario and they have a plan to follow that they can check off piece by piece. And it's a very similar concept here with trading plans. A trading plan is a framework that gives you clear, objective instructions to follow before, during, and after your trade. Now, note those adjectives there. It must be clear. If you've got a wishy-washy trading plan or it's a sort of, maybe, could have, that sort of wording, you're not going to be able to use it to make good decisions. There'll be too much confusion. It needs to be crystal clear and they need to be objective. You need to be able to give that trading plan to 10 different traders and they should all be able to trade it the exact same way and get the same results, or at least give the same instructions to the broker. Sometimes they might all take the same trade and get filled at slightly different places, which is rare in the FX markets, but it can happen. But they should be able to follow those instructions objectively and all get the same outcome there. And that trading plan, as you can see, it covers before you trade, during your trade, and after your trade. And that's what we're going to take a look at now. At Safety in the Market, we teach a 6-part trading plan. And we refer to that as the Trader plan. Trader is an acronym that we're going to go through in the next slide. So let's talk about this Trader plan. The T stands for a trigger. Professional traders all have trigger points that are going to get them into the market. As I said, it's not a case of just showing up and saying, oh, that looks pretty good, I might trade that. We have specific, clear triggers, and once that trigger is activated, we know straight away we jump into the market. And there are 4 triggers that I use on my trading plan, and I'm going to show you one of those a little bit later. Next, we have the reward to risk ratio. And if you've watched the video on our YouTube channel called Trading the Easy Way, you'll know the importance of a high reward to risk ratio trade. Now, isn't it interesting? As soon as a trade is triggered for me, the very first thing that I do is I check the reward to risk ratio. Even though at this point, I've done my analysis, I've got a swing chart and price forecasting set up, so I believe I'm at the start of a new trend. I think everything's lined up and I've got a trigger. But instead of then going and filling in my orders to the broker, I'm checking the reward to risk ratio. And the reason is, I don't care how good a trade is if it's not going to pay me enough money. So for example, with reward to risk ratios, if you're risking $100 on the trade, and if you're right, you make $200, we call that a 2-to-1 reward to risk ratio. Your reward or your profit is 2 times the size of your risk. And conventional thinking in trading says that if you can achieve a 2-to-1 reward to risk ratio and a 50% success ratio, where you're right half of the time, then you will be a profitable trader. Now, I don't disagree with that statement. It is true, but that's what I call trading the hard way or trading the slow way. And again, if you watch my video on YouTube, Trading the Easy Way, you'll see that adjusting your reward to risk ratio and not settling for small reward to risk ratio trades is the fastest way to get where you want to go in trading. So before I do anything else, as soon as I see a trigger, I check that reward to risk ratio. Then I assess the trade, and this is not a full-blown assessment. I've done most of the work for the trade by now. It's just a little checklist depending on what kind of market I'm trading, a few little things to check off just in case there's something that I've missed or that I've forgotten. It's very, very easy in trading to see an opportunity and jump into the market. But sometimes we just need to pull ourselves back for a second or a few seconds and just make those final assessments just in case. So as an example, there may be a big news announcement coming out in a few hours that I might want to wait for. Or if I'm a stock trader, I might pay attention because there's a dividend coming out the next day that I think is going to drop the price of the share. So little things like that should be in your trading plan just to stop you from pulling the trigger too early. But once that's all ticked off, it's time for delivering your orders to the broker. When David Bowden, the founder of Safety in the Market, was trading, he had to physically pick up the phone and ring the broker and sometimes wait online and then talk to a broker and say, I'd like to do this order. And then the broker would read it back and say, yes, that's right. Go ahead and do that. These days, it's very easy. We can just type our orders into a trading platform and we can literally be in the market in seconds. In fact, many day traders will have their platform set up and it will be a one click to get them into the market. That's how quick it is to get into the market. But we'll talk about orders a little bit later. After you've delivered your orders to the broker, there are still things within your trade that need to be executed. So for example, while that trade is open, you'll want to keep an eye on it and maybe move your stop loss up at key areas to take some risk off the table and lock in some profit. You might like to add additional positions with the market's money. That's called compounding. Or of course, if something changes in your trade or in your outlook, you might like to jump out of that trade early and just take whatever profit you have on the table. So there are things at this level during the trade that you do need to keep an eye on. So those first 4 items on the list, trigger, reward to risk ratio, assess the trade, and deliver your orders, they all relate to before the trade is taken. Then once you're in the trade, during the trade, you've got this 5th line here, which is executing your trade and just making sure everything runs smoothly. And sometimes executing your trade simply means taking your hands, putting them in your pocket so that they're not on the keyboard or on your mouse, ready to click and sabotage your trade, but you just let the market unfold and do what it's going to do. That's another part of executing your trade. But these are all instructions that you're going to need to write into your own personal trading plan to make sure that you handle the trade in the best possible way. Then finally, once the trade is completed, we move to an after the trade process called review. Professional traders are all about improvement, and it's always a good idea to review every trade you take, no matter whether it was a win, a loss, or a break even, or if it didn't get triggered in the first place. So I believe every trading plan should contain these 6 things: a trigger for entry, a reward to risk ratio check and benchmark to make sure that you are very clear on how much you want from the market, some final checkpoints or assessments of the trade before you take them, a swift way to deliver your orders to the broker, rules for executing your trade as it unfolds, and of course, a review process at the end. Let's explore these in some more detail now. Let's assume that as a trader, you've done your analysis and you've identified a double bottom formation in the market. Now, double bottoms are a fairly simple pattern in the market. A lot of traders use them. There are better techniques out there, but they are good, reliable patterns when they do happen. So let's assume that you've seen the double bottom. Now you're waiting for a trigger to enter the market, and you have to decide for yourself, what is that trigger going to be? For some people, they will look to buy as soon as the market gets the double bottom. They won't even wait for a trigger. Others will wait for the market to turn up out of those double bottoms. Others still will wait for the midpoint of those double bottoms, or the high in between those double bottoms. They'll wait for that high to be broken. And once that high is broken, they'll then look to enter the trade. So everybody has their own triggers. Let's assume in this case, our trigger is going to be the double bottom confirmation as the market moves up out of that double bottom. So there's our trigger to the market. So we can get in at this point. But this is where you would then move on to your next step, which is to check the reward to risk ratio on the trade. Again, I don't care how good a trade looks. If the reward to risk ratio is not high enough, I'm not interested in taking it. There will be hundreds, if not thousands, of very high quality, very high reward to risk ratio trades that will come your way throughout your trading career. If you have the patience and the discipline to wait for those, you will be very well rewarded, and you'll miss out on a lot of the frustration too that comes with when people chase these trades with a little 1.5 or 2 to 1 reward to risk ratios. Now, the formula for calculating reward to risk ratio is we take our reward and we divide it by our risk, and that gives us our reward to risk ratio. So if our reward or profit on the trade is $400 and our risk on the trade is $200, that would give us a 2 to 1 reward to risk ratio. The higher that number is, the more profitable that trade is going to be, and the more bang for your buck you are getting. You can take 2 trades, one with a 10 to 1 reward to risk and one with a 2 to 1 reward to risk ratio, and they're both going to need a similar amount of risk that you're putting up. So you'd be risking the same on both of them. Why not choose the trade that's going to give you the higher reward if you're right? At Safety in the Market, we teach our students to look for, and in some cases I say demand, a 10 to 1 or higher reward to risk ratio on trades. Now, in the early days, that can seem a little bit daunting because you think, oh, 10 to 1, how am I going to find a 10 to 1 trade? That's a huge trade. It's actually not though. When you understand how to use swing charts, you can actually zoom right in and get very close to these big picture weekly and monthly turning points in the market. And you combine that work with your price forecasting. And sometimes you can call tops and bottoms to within a tick, or sometimes even perfectly in the market. But even if you're not perfect, even if you're out by 0.25%, you can still get in very, very close to that move using this 2-pronged approach of swing charts and price forecasting, or trend and turning points. And you can get in close, and you can find that often a 10 to 1 reward to risk trade is actually conservative. Now, you're not going to be able to take 10 to 1 trades multiple times per day on the same market every day of the year, but you will find at least one of these, if not more, most months on most markets. So it is worth taking the time to learn how to find these and then having the patience and discipline to wait for them to arrive in the market. Now, a 10 to 1 or higher reward to risk ratio, this is what is called trading the easy way. That means that if you're right on that trade, if you're risking $100, you make $1,000. That means you've got to be wrong 10 times in a row just to be back to break even. Now, you might be wrong 2, 3, 4 times in a row. It's very rare that you're going to be wrong 10 times in a row in the market. So these high reward to risk ratio trades are a great way to build your account quickly. And they're also a great way to bounce back if you have had a few losing trades, because you'll be down 1, 2, or 3 units of risk, and then a 10 to 1 recovers those 3 units of risk that you had lost, and you're now 6 or 7 or 8 to 1 or higher in your account. So it's very, very important to look for trades with a high reward to risk ratio. And the quickest way to increase your reward to risk ratio is to enter into a trend earlier, because that's going to give you a lower risk. So let's talk about reward to risk ratio. We've found a good looking setup in the market, and we've seen a trigger that tells us it's time to get into the market, or there's an opportunity to get into the market. I want to check my reward to risk ratio, but at this stage, there's no need to go through and calculate your position sizing just yet. The reward to risk ratio is going to be the same whether you're trading a $10,000 position or a $10 million position, because the reward to risk ratio isn't a dollar figure, it's just a ratio. So 2 traders, one with a small account, one with a large account, could take the exact same trade, and one might risk $5, one might risk $50,000, but their reward to risk ratio is going to be the same. And the reason for that is the reward to risk ratio is calculated just based on points or ticks in the market. So if you're risking 50 points and your profit target is 500 points away, that's a 10 to 1 reward to risk ratio. If you're risking $100 on the trade, you're going to make $1,000 if you're right. If you're risking $1 million on the trade, you're going to make $10 million if you're right. In both cases, it's a 10 to 1 reward to risk ratio. Now, position sizing can take a little bit of time or a few extra steps on your calculator. So I like to just look at my trade straight away. If I see a trigger, that tells me where I'm getting in, where my stop loss is going to be, and where my profit target is going to be. So I can very quickly work out my reward on the trade, which is my profit target minus my entry price. I can work out my risk on the trade, which is my entry price minus my stop loss price. And then I can work out that reward to risk ratio very quickly within a few seconds. And usually I get a rough idea in my head and I'll know straight away, yes, this is more than 10 to 1, or no, this is less than 10 to 1. But that's really, really important, because as I said earlier, if the reward to risk ratio isn't there, I'm not interested in taking the trade. As a trader, I want everything that I can to be in my favor before I jump in and take the trade, because at the end of the day, I'm trading with my own money and I want to protect that. Now, if the reward to risk ratio checks on, we can move to the next stage, which is to assess the trade. And at this stage, you are just about ready to place your orders with the broker. You're almost good to go. And it's very easy to race into trades. And I've done it myself, where you think, oh, it's going up, click, jump in. And I haven't checked. And then in those cases, you're bound to miss something. As I said earlier, there may be a news announcement coming out. There may be a speech that's being given by the central bank governor. If you're a stock trader, there may be a dividend announcement or an earnings announcement that's coming out. So you want to just have a little checklist in place to ensure that you've covered all of your bases. It's not a big, complex thing. Generally speaking, you'll just have a few little tick boxes, and you'll have a few things that you want to check based on your experience before you jump into the trade. You'll tick those off and you'll say, yep, that's fine. It's time to go. This is not a stage where you're doing complex analysis of the direction of the market. You've done all of that already before you come to your trading plan. You don't come to your trading plan until you have an opportunity and it's time to trade. Once you come to your trading plan, all your analysis is put aside because your mind is made up, and now you're focusing on taking the trade. This is just one last check to make sure that you've covered all your bases and you're not missing or forgetting anything. Now, if everything checks out, it's time to deliver the orders to the broker. These days, most people are likely to enter their trades directly into a trading platform. So you'll just open up your trading platform and you'll type the relevant numbers in. And the numbers that you're going to need to know are your position size. So how much of the currency pair do you want to buy or sell? You're also going to need to know your entry price, and that's going to be determined by the trigger that you chose to use to get into the market. You'll need to know your exit price as well, in this case, in the form of a stop loss. So if you're wrong on the trade, and it does happen, and if the trade goes against you, where are you going to get out? That's very important. Before you click that buy or sell button to execute the trade, you've got to have that exit price ready to go. You never put your stop loss on later. All of this gets delivered at the time that you place the trade, because most traders will tell you at some point in the market, you're going to take a trade, and then as soon as you take it, it moves against you. We all go through it at some point, and in those cases, sometimes it moves very, very quickly. And if you don't have time to put your stop loss on, you can end up losing more than you thought. And then, of course, you also need another exit price, which is your profit target. So they're the four things that you're going to need to know in order to deliver your orders to your broker. The entry and the exit prices are all going to come based on your analysis that we discussed in video 5. So you're going to have to decide how you want to trade and build your trading plan around that accordingly. And then, of course, the position sizing we went through in video 4. So if you're still not 100% sure on how to set your position size, make sure that you review video 4 of this trading course. Now, of course, if you're a Safety in the Market student, remember that you do have access to the Trading Tutors service. This is their bread and butter. If you're going through and you've forgotten how to do your position sizing, or you're not quite sure of the entry price or where your stop loss goes according to the rules, you can send an email to the Trading Tutors support desk and you will get that answered. That's one of the things that I have always loved about Safety in the Market, the Trading Tutors support service. I was a student of Safety in the Market back in 2004, 2005, and as a former student, if I had a question, even today in 2022, and I thought, oh, gee, I've forgotten my entry price or I've forgotten my position size, I can still type that question into an email and send it to the Trading Tutors and get the same level of support, which not too many companies that I know of would offer that kind of service. So at Safety in the Market, we say, once a student, always a student. And if there is any way that we can help you or support you, we will do that. So again, if you're a Safety in the Market student, use the Trading Tutor support service if you need them here. Once you've delivered your orders to the broker, the first thing that you can do is relax, take a deep breath, and just get ready for the trade ahead. This trade could last for weeks, or it could all be over in 30 minutes. You don't know. So just relax, and whatever's going to be will be, and your trading plan is going to take care of you. However, once you're in the trade, you still need to remain vigilant, because there are still decisions that you're going to potentially have to make. You don't have to make them. You can, as I said, if you've got a stop loss order and a profit target, you can walk away from that trade. You can go on holidays. You can look at your trading account in a month's time. It doesn't matter. Your broker will manage that for you. However, there are other things that you may like to consider. For example, you might, at some point in the trade, like to move your stop loss up. So initially, you might be risking $100 on the trade. At some point in the trade, you might like to lift that stop loss up so that you're no longer risking $100 on the trade. You're now at break even on the trade, or maybe a little bit of profit on the trade. You might like at some point to add extra positions into the trade. So this is called compounding or pyramiding, and it works like this. You take an initial position in the market and the market moves in your favor. So you move your stop loss up to lock in some extra profit. Then using that profit, you take some more positions in the market and then some more positions as the market keeps moving. And what you're doing is you're building a bigger and bigger position size, but you're lifting your stop loss higher and higher as you go so that it's all done with the market's money. So that if it comes undone and the market moves against you, you either get stopped out for a break even or a small profit. Or if the market goes in your favor, you've now got a massive position that you've built up through pyramiding or compounding, and you can take advantage of a much larger profit. Now, whether it comes to moving stop losses or adding extra positions, you don't want to be thinking about that in the middle of a trade when you've got all this money that you see, this paper money that you haven't banked yet because it's still the market's money until you close the trade. You don't want to be thinking while you're in that state of greed, oh, I'm going to take all these extra positions, or I'm going to move my stop loss really tight, and then you might miss out on the rest of the move because you get stopped out early. you want to have plans for doing this that have been put together before you got into the trade. And again, really, really important to have this set up before you jump into the trade, because once you're in the trade, you're subject to the emotions of fear and greed. But when you're not in the trade, those emotions aren't there, or at least they're not there as much. So make sure if you're going to do these, you have rules for them. There is also a third scenario, and that's where sometimes you want to exit the trade early if something happens. Sometimes there'll be a price cluster that appears in the market that you hadn't seen earlier, or that was just forming now and that you've missed, and you think, well, I might take profits here. I'm not going to fight this. I'm going to take profits. Or some news might come out and the market might start moving against you, and you might think, oh, maybe I'll get out there. These are subjective things. The first two items there, moving stops, adding extra positions, they should be objective decisions. Exiting the trade early, there's a lot of things that can happen. Basically, you don't want to make a habit of exiting your trades early, but if something clearly happens, it's changed the outlook on the market, well, it is an option there for you. So you should consider when and under what circumstances you will exit the trade early if something changes. And the last item on our list is the review process. Whether your trade is a win, a loss, or a break even, it's really important to have a review process. I'm not talking about sitting down with a psychologist and reviewing, oh, what was I thinking here and here and here, and spending hours dissecting and stewing over a trade and thinking, oh, how could I have squeezed a few more cents out of this? But you want a review process to look over and say, well, did I follow my rules? And did I stay in control of my emotions throughout the trade? It doesn't have to take long, but it is important. The best traders are always looking for ways to become more efficient and more profitable. So after you've taken a trade, take some time to review things like your analysis on the trade. Did you get it right? Did you leave money on the table? Did you get out too early? Did you get out too late? Think about your analysis and how it performed. Think about your own emotional control. Some people are very, very calm until their money is put on the line in trading, and then they're an emotional wreck. Now, if that's the case, you need to find ways to deal with that. And there are ways of dealing with that, of course. And one of the best ways of dealing with that is once you're in a trade, turn your computer off and let your broker manage all of the orders and go and occupy yourself doing something else. Go and read a book, go and play golf, go and watch a movie, go and get a massage, or for many people, they'll go and work a job. And sometimes people see that as counterintuitive. They say, oh, I don't want a job, I want more time for trading. But for some people, actually having a job and doing trading on the side is the best thing for that person, because it keeps them occupied and stops them from looking at the market every 5 seconds and getting emotional about it. Also take some time to review whether you followed your trading plan and whether or not you made any mistakes along the way. So these are all things that you can consider including as part of your review process. So when it comes to setting up for an FX trade, following the trend of the market and finding the turning points will lead you to a trading opportunity. Then you put your analysis aside and you pull out your trading plan, and filling in that trading plan is going to allow you to trade that opportunity with safety. And that's all there is to it with trading. Now, as I said earlier, over the course of your trading career, you're going to take thousands and thousands of trades. A great piece of advice to remember comes from the late Dr. Harry Stanton, who was a very respected trading psychologist who used to present some seminars with David Bowden, the founder of Safety in the Market. And Dr. Harry said, treat each trade as just one of the next 1,000 trades that you're going to take. Don't put too much importance or significance on it. Don't build a trade up into being the one trade that's going to elevate you to financial freedom, and then you take this one trade and you'll never have to worry about money again. And similarly, if you take a bad loss on a trade, don't read too much into it. Don't sit and stew on it for days or weeks or months and beat yourself up over it. Just treat each trade as one of the next 1,000 that you're going to take. Relax about it. After the trade, review it, take any lessons that you can from it, and then move on to the next trade that you're going to take, because you are going to take so many trades. Sometimes it feels like this trade is more important than another trade, but at the end of the day, every single trade that I take, I treat exactly the same way. I don't look at a trade and say, oh, this trade, I'm going to make a killing on this trade, I'm going to smash this trade. I look at the trade, and every trade that I take, I think is a good trade, because I set them up the same way, and it's a high probability system. But some of them don't work out, and as traders, that's just life. So it's just one of the next 1,000 that we're going to take, then we move on to the next one. Now, we're getting towards the end of this 7-part trading course. And if you're still with us, thank you so much for being a part of the process. I hope you've enjoyed it and I hope that you've learned plenty of things from it. Before you go, I'd like to give you an exercise, and it's an exercise that has served me very, very well in my trading and in my research, and I think you're going to get a lot of value out of this. What I'd like you to do is take some time to study some previous moves on your chosen markets. So if you're here, you're obviously interested in trading currencies, but you might like to trade other markets as well, like the NASDAQ or perhaps some stocks or perhaps the oil market or the coffee market. But whatever your markets are, take some time to go through some previous moves on those markets. In our last video, lesson 6, History Repeats, we gained a lot of knowledge from things that have happened previously. Well, we can do the same thing by looking at market charts. We can look at previous moves and we can learn from them. What I want you to do is to look at some of the big tops and bottoms in the market and see if your current systems for trading could have helped you to trade these turns. And there are 3 things to keep in mind as you do this exercise. Firstly, I'm asking you to look at the big tops and the big bottoms. In between, from say a big top down to a big bottom, you're also going to have a big downtrend in the market. So there are a few things that you're looking for here. You want to ask, could my system have helped me to trade with the trend as this market fell from the top down to the bottom? That's the first thing. The second thing you want to ask is, could my system have helped me to recognize the top as it was happening and then recognize the bottom as it was happening? So that you're not just relying on the trend, but you can also call the start and the end of the trend using turning points. So that's 2 things. Could you have traded the trend? Could you have recognized the tops and bottoms? The third thing to ask is, how many trades could you have taken during that run from the top down to the bottom that would have produced a reward to risk ratio of 10 to 1 or more for you? And you'll be able to find a lot of value in doing this work. You'll be able to look at areas where your system works really well, and you'll also be able to find areas where there may be some holes in your systems. So, for example, you might have a system for trading the trend of the market, and you might think, well, I'm pretty good in the middle of the trend here, but I'm really missing out on a lot of profits at the start and the end of the trend. So in those cases, you can realize, well, maybe I need to do some more work on learning how to find the turning points in the market. And as I've said in previous videos, that's where the price forecasting skills in the Active Trader program are really going to help you out. But either way, this is an important lesson for you to go through. It's an important exercise, and you are going to get a lot out of doing it if you put a little bit of time into it. David Bowden, the founder of Safety in the Market, used to say, your hindsight will become your foresight if you use it often enough. So if you look at these previous moves often enough and you look at them in hindsight, then eventually if you study them enough, you'll start to recognize when markets are getting set up to do the same thing. So you'll start to recognize them as they're happening. And if you get really good at it, as David was, you'll be able to recognize these things before they happen. And that's what's called forecasting in the market. And that's what Safety in the Market can teach you. So I'll show you an example of when I undertook this exercise. And it's again this 1992 British pound top that we've spoken about in a couple of videos already. But when I read about this trade, and you can see this massive down bar in the middle here where the pound lost 10% of its value in a single day, I read that a gentleman named George Soros made $1 billion US of profit trading this move short in a single day on the British pound. And I thought, gee, $1 billion from just one day's worth of trading, that's a useful sum. And I thought, I wonder, could I take my existing skills and my existing skill set and apply them to this trade? And could I have come up with that decision to short that market? And I'm really glad that I had that thought and that I acted on that thought, because I went back and I studied this move, and a lot of the things that I do today in markets and in price forecasting, I got from this particular top, because this was a major top. The pound had been running up for 7 years. It hit a massive price cluster, and then the market fell apart from there. And you can actually see it if you study it for the years leading up to it. You can actually see that top it was almost destined to happen years before it actually did. And in fact, I did a lesson on this once where I wrote everything down, I put all my work together, and I stepped students through it week by week, month by month. And then as we approach that top, you can see that the price of the top there was predictable years before it happened. And then as we got closer and closer to the top, if you think about the brick wall analogy that I used earlier, where you've got price milestones all coming together at the same point, we just saw brick after brick after brick getting put into the wall there. So the market really did hit a brick wall at that top there. And after studying that, I took away a particular pattern that occurs in financial markets from that. And I continue to look out for that pattern today. And sometimes you'll see that pattern occur on a very small scale. This was a January 20 top this year on the Australian dollar. That's the most recent example I've seen of that pattern on the currency markets. But then sometimes you'll see it unfold on a massive scale. And I mean, look, on a small scale, you still got a really good crash there. But then you look at some other markets. We saw that same pattern on the DAX in 2020, and we saw the market crash there. And that was a very, very similar trade to the British pound trade. In fact, all through 2019, I was telling students in our coaching programs here at Safety in the Market, do some study on that British pound top and compare it to the DAX market, because there are a lot of similarities in the way this is unfolding. And there we go, the market crashed. We also saw it on the S&P 500 there. That was the top just before the COVID crash in March of 2020. And that top I called a few months before it happened, and I was right to within 0.5%. And then again last year in November of 2021 on the NASDAQ, the exact same scenario, all coming together again to call that top. Now can you start to see the importance of going back over some previous moves and studying them? Because as we've seen in previous videos, history does repeat in the markets, and you'll find that around these big turning points, mathematically, everything lines up, your numbers all come together, and you'll see a crystal clear top there. Now, I'm not saying you can do that all of the time and that I call every move in the market and that I'm never wrong, all these sorts of things. But in these cases, this particular setup is worth studying, because it does happen at least a couple of times a year on most markets, and it will give you a really good trade out of there. Now, if you're a Safety in the Market student with the Active Trader Program online training, you can actually walk through that exercise that I was talking about earlier. I took my notes on the British pound and we added them as a bonus a little while back into the Active Trader Program online training. So if you want to study that pound top, just open your Active Trader Program online training and scroll down to the case studies that you can see at the top, and then just click on 1992 British pound crash. There's about a 1-hour video that you can just sit back and watch. Or if you want to work through it with me, I've broken every part of the forecast down into notes, and you can work through one line at a time, and you'll see exactly where, when, and why I put it on my chart. It took me a lot of time to put that together, but it's very, very valuable for you to learn how to put these crash tops together in the market. Now, that's only one kind of trade. If you want to go and learn how to trade sideways markets, go and study a whole bunch of sideways markets. If you want to learn how to trade bottoms in the market, go and study a whole bunch of bottoms. But this particular trade is all about that British pound crash. And I know for me as a trader, nothing gets me more excited as a trader than a big market crash. So of course, I went and studied how market crashes come together. Once you've studied them long enough, and then you see a few of them, you'll see that there are certain patterns that occur over and over again. And well before that top comes in and well before the market collapses, you'll be able to put that together. Now, if you're not a Safety in the Market student, or if you don't have the Active Trader Program, I'll just tell you a little bit about it very, very quickly. Initially at Safety in the Market, when I was a student, I did what was called the Active Trader Program. And that contained the Smarter Starter Pack, which teaches you about the trend of the market, and the number one trading plan, which is all about calling the turning points in the market. So those two courses together will help you to understand the trend of the market and the turning points. In other words, the start of the trend and the end of the trend. And they're a pretty lethal combination, the two of those together. And one day, if I'm lucky enough to teach my children how to trade, that's exactly where I'll get them started. A couple of years ago, however, Di, the general manager of Safety in the Market, asked me to help her update these and bring them into an online platform to make it easier for people to access. And that's where the Active Trader Program online training was born from. And the Active Trader Program online training, or what we call ATPOT, served two purposes. Number one, it brought everything online. And number two, it was also an upgrade to the starter pack and the number one trading plan manuals. In that we went through, we provided new up-to-date case studies, and we also broke down every single lesson in those courses into smaller chunks to help students' comprehension. So what that means is when you're reading something in the Smarter Starter Pack or the number one trading plan, the lesson is all there. But in AtPot, I take that lesson and I break it down into small 3 to 5 minute video chunks so that you can just focus on one step at a time, master that step, and then move on to the next one. And we've noticed a massive increase in the results of our students since we released the program in that way. And the number of students who are now taking trades of 10 to 1 or more has just increased so much. And obviously that's very pleasing for us at Safety in the Market because we put a lot of time into creating this program and into getting it just right. So these days, the Active Trader program has been replaced by the Active Trader program online training. So you still get David's original courses, the Smarter Starter Pack and the number one trading plan. And there were manuals that came with that. And of course, some videos and exercises. But you also get the Active Trader program online training, which is a whole new set of videos that will take you through everything. I put that together myself, and the whole focus of the Active Trader program online training is finding trades with a reward to risk ratio of 10 to 1 or more. Now, from time to time, we add additional bonuses into the Active Trader program. So once you have that, any updates that come through, you will receive automatically. So for example, the 1992 British pound lesson, that was a bonus lesson. There's another bonus lesson in there on advanced price forecasting. And there are a few more that we will be putting in over the coming months and years as well. In addition to that, at Safety in the Market, you receive ongoing email support. So as I said earlier, once a student, always a student. So as you go through that Active Trader program online training, there's no rush. You take your time, you work through it in your own time. And if you do have any questions now or in the future, you can email those through and you can get support. It really is a fantastic program, and I know that it just did wonders for my trading, and I know that it will do the same for yours. So if you do want to check it out, make sure that you click on the link in the description to this video. It's free, no credit card, no payment required. Just jump in there, put your email address in, and you'll be able to access those first 15 lessons. Now, I believe the Active Trader program online training is hands down the best value for money trading program that is out there. But on top of that, at the moment, we also offer 3 months of group coaching and mid-month updates to all new purchasers of the Active Trader program online training. So if you enroll in this Active Trader program online training, you'll be added to a group coaching session where we meet once a month for a couple of hours and we go through the techniques. You can ask any questions and we look at current market examples across a range of markets. And then in between those live coaching sessions, around every 2 weeks before and after those sessions, I do a mid-month update as well. So you get a market update on current conditions as well. Now, I'm honestly not sure how long that's going to run for, but as it stands at the moment, when you upgrade to the Active Trader program online training, you do get that 3 months of group coaching and updates as well. From my point of view, this is a terrific program. It did wonders for my trading. It turned my life around. And when my children learn to trade, if they decide that they want to trade, this is where I will start them. I believe that this is where every trader should start. It's a complete program. It will teach you how to trade with the trend and to identify those turning points. And it will give you a trading plan for getting in and out of those trades mechanically. And as I said, it will help you to really concentrate and focus on finding those trades with a 10 to 1 or higher reward to risk ratio, because that's where you want to be. As I said, that's what is called trading the easy way. So that brings us to the end of this 7-part trading course. Thank you very much for joining us, firstly to the end of this video and also to the end of the course. In this course, we've covered all of the different elements of FX trading. It's now time for you to go away and make some plans. So there are 3 kinds of plans that every trader should have. The first kind is an analysis plan. And your analysis plan is going to help you to determine the direction of the market. I've already shown you my analysis plan. I use swing charts and price forecasting to look for the start and the end of turning points in the market. So my analysis plan delivers that outcome for me and provides me with trading opportunities that have a very high probability of success and a high reward to risk ratio. Every trader should also have a trading plan. So I've taken you through the trader plan, those 6 things that I believe every single trading plan should have. It's up to you to decide which of those you want to incorporate in your trading plan and how you want to set all of that up. There is a third kind of plan that we haven't had time to go through, and that's a trading business plan. Professional traders treat trading as a business. It's not a hobby. It's not a side hustle. It is a business and it should be treated that way. So it's very important that you have a business plan. Now, going through business plans is beyond the scope of this 7-part FX trading course. However, for those of you who would like to get started on a business plan, what I would encourage you to do is to click on the link in the description to this video to take you to the demo version of the Active Trader Program online training, because there are videos in there that are relevant to your trading business plan. So at the bottom of this video, you'll see something like this, the title. Obviously, as I'm recording this, it's not up on YouTube, so I can't take a screenshot of this video, but there's a screenshot of our Part 5 video. And at the bottom, you'll see this little link here that's going to take you through to the Active Trader Program online training demo. So if you click on that, it will take you to this screen here. All you have to do is enter your name and your email address. No credit card, no payment, nothing like that. Click on Submit, and you're going to be able to access the Active Trader Program online training. You'll want to start by clicking on Active Trader Program online training. As you can see, there are 10 topics or 10 lessons in there. And then there are 3 lessons taken from the Smarter Starter Pack and 2 from the #1 trading plan. So all up, you get 15 free lessons from this program to see if this is a program that might be right for you. If you click on the Active Trader Program online training, you'll see the lesson content there. And if you just move down a few lessons, you'll find trading as a business in there. So all you have to do is click on that. You'll see a video. That's me, by the way. Hello. I do all the videos in this program. I'll have a video lesson and some text, and then sometimes some exercises as you're going through. And in this case, I'm taking you through getting your business plan started. So if you've enjoyed these 7 videos, I can promise you there is so much more for you waiting in the Active Trader Program online training. But as I said, don't just take my word for it. Click on the link in the description, check out that demo for yourself, and see for yourself what's in there. Thanks again for watching this video and for being a part of this FX trading course. I'd like to wish you all the best in your trading. And if there is anything that we can help you with at Safety in the Market, please don't hesitate to contact us and let us know. All the best with your trading, and bye for now.